Most Canadians think the Bank of Canada controls mortgage rates, but the truth is, it doesn't. Your mortgage rate is actually being set by a global financial system most people never even see. And this week, a viral video circulating online accidentally touched on something really important about how that system really works. Now, the video itself claimed that the United States cut Canada off from global dollar system. That didn't actually happen. But the reason the video got so much attention is because it hints at something real. The global financial system runs on trust in the US dollar and the bond market that's behind it. Let me explain. Most people assume mortgage rates move when the Bank of Canada changes interest rates. But fixed mortgage rates are actually driven by bond markets. In Canada, fixed mortgage rates follow the Government of Canada 5-year bond yield. And that bond yield doesn't just move because of domestic policy, it moves because of global capital flows. Pension funds, central banks, sovereign wealth funds, and institutional investors all over the world buy and sell government bonds. When demand for those bonds rises, yields fall and the borrowing costs tend to come down. When investors sell bonds and demand higher returns, yields rise and borrowing costs increase. That's why sometimes mortgage rates can move even when the Bank of Canada hasn't changed a thing. The global bond market is constantly adjusting based on inflation expectations, economic growth, and investor confidence. And at the center of the system is the U.S. Treasury market, the deepest and most liquid financial market in the world. Government and central banks hold U.S. Treasuries as reserves because they are considered one of the safest assets available. So when confidence in that system shifts, capital moves and global interest rates respond. For Canadians, the takeaway is simple. Mortgage rates aren't determined by one institution or one announcement. They're influenced by a much bigger system involving global investors, bond markets, and capital flows. Understanding that bigger picture helps explain why borrowing costs can change quickly, even when the headlines make it seem like nothing has happened. And it's why global financial developments, even ones that start thousands of miles away, can still affect mortgages here at home in Canada. So when people ask, well, I'm not in Canada, so when people ask why mortgage rates change even when the Bank of Canada hasn't done anything, this is why. Because mortgage rates are connected to something much bigger than one announcement or one policy decision. They're connected to global capital flows, bond markets, and investor confidence around the world. And understanding that bigger picture is one of the reasons I've been able to help clients navigate mortgage decisions for almost 3 decades now. My name is Brienza. I've been working in mortgages for nearly 30 years, which honestly still feels surreal to say out loud sometimes. My business has always been built almost entirely by referral. And the reason for that is simple. People know that they can count on me, not just for a rate, but for helping them understand the strategy behind the mortgage decision that they're making. So if you found this explanation helpful, feel free to follow along, because I continue breaking down how policy, markets, and global events affect mortgage rates and housing here in Canada. I do this every single week, so stay tuned. And until next week, be well.